All right, so in this video, I'm going to go through ICT's Venom Model, as he recently released a video on it on his YouTube channel. Now, of course, he's not, disclosing all the information about the actual model, but in this video, I'm gonna just go through um, what he has taught about it, and more importantly than that, how to get your bias right and your narrative and actually frame a trade in the right direction, right? Because these models are all basically ways for him to get into the market. Now, if you've seen the video that he posted, you know he masqueraded his entry as the first presented fair value gap. Now, it's not much difference in terms of how early he got into that trade that really went for it, but yeah, the most important thing is being able to understand where price wants to go, and of course where it has been, right? So I'm going to show you how I would do that first using NQ. I'm on the continuous contract chart at the moment just to show you. So I'm going to start on the 8 month, okay? And I'm going to use the replay tool. 1 second. So this is the 8 month candle that we had. And in January, this is how we opened, right? So what am I noting here? An 8 month, basically an 8 month busy here. And I'm also annotating the high of this candle as well, right? Because we have some market structure, and generally price comes back down to these areas and back down to inefficiencies, because the market simply is running on liquidity and efficiency, right? It has to be efficient and it needs liquidity. The analogy I like to use is, if you're going on a road trip cross country, you need to stop for petrol or fuel at times, right? That's the liquidity. Okay, you need to take these little pit stops. And efficiency is basically the vehicle in which you're taking the road trip with. If your vehicle is not efficient in how it operates, it will overheat, right? If your vehicle is overheating, it's going to break down. It just doesn't work, right? So to be able to do that, for the market to move, it relies on liquidity and efficiency. Okay, so we do have inefficiency here on this time frame. Okay, and eventually we saw the candle. We came down for it. I'm going to go down to just a lower time frame now, like the monthly. Okay, so we have the 8 month here, and we have some sell side here, relative equal lows, a bit more visible on this kind of time frame like the weekly. Very clean, and we have price moving up very efficiently, as well as creating this nice trend line with the inefficiencies below. So when price is moving like this, creating the liquidity below here, the options it has are to either take the liquidity and move higher, or displace down, start attacking the sell side liquidity below here, equal lows. All right, so these are generally where people put their stops or their entries if they are breakout traders. And trend lines are basically low resistance because there's no significant swing point. These are very easily swooped up, and when you see trend lines like this, price moves very fast against them. If it reverses, there's a higher time frame narrative in play. If not, then it will start attacking further sell side. Okay, because there's an inefficiency here on the 5 month as well, but very high up. Okay, we didn't close above this candle on the 5 month, so we attack that and attack this. So I'm just going to remove this. And now we're here. Okay, so let's look at that on the daily again. Very nice. We expanded down, created one inefficiency, created this order block, and then we started spooling lower, 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 and then we gapped here. Okay, and let's go look at that gap, which is going to demonstrate the ICT Venom model. Okay, so we had anticipation to attack the sell side here. Easy, right? Equal lows. That is the narrative. That is the narrative. All right, and we had a big gap down that is even more indicative that we are in a rush to get there. Okay, so keep that in mind. We're in a rush to get somewhere, and we've also even gapped down lower. Okay, so let's go. I'm going to go to the June chart, NQ, because that's what he was using, and that's what I've annotated on. Okay, so in here, right? And I think the sell side was somewhere here. So let's have a look at that on the 1 minute up here. So the first thing he did was annotate the gap of the regular trading hours, which is down here. Okay, and a gap, big gap. Look at this expansion, manipulation, of course, but that's not narrative. We're not going higher, we're going lower. Okay, so we gap down all this way, huge gap. Okay, huge gap over here, and this is how we moved in here. And now I'm going to go to the electronic trading hours. But I just want to note that most of these gaps tend to get filled, right? There's an opening gap here, it gets filled. There's even one here, look at that. Comes all the way. That was the one that filled this gap. And this was a big gap, okay? And when you gap so fast, we're most likely in a rush to get somewhere, not come back and fill the gap immediately, right? Generally, the market, when it moves really fast, it does not want to give people a chance to get back in or chance to get out their positions if they were long and now they're in a drawdown. It does not want to give them a chance to get out. Okay, it wants to keep pushing, 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 either liquidating them or scaring them out of the positions. Okay, so let's go to the 1 minute with that in mind in the electronic trading hours. Okay, this is not a model I use. I rarely trade NQ. I usually trade forex. But let's just have a look. This is the range here in quadrants of the electronic trading hours gap. Okay, midpoint, equilibrium, and we have the 25%, 75%, and the two extremes. So this is what he was demonstrating with the Venom model. So we have a 90-minute window from 8 o'clock to 9:30 where equities open. All right, the 9:30 bell is over here. So at this point, there are two sides of the market, right? We have the buy side and the sell side, two swing points. We come up, we expand down quite efficiently. Mind you, this is also low resistance, no significant swing points. These kind of things, it's like a trend line. It can be swooped up very quickly, like a conveyor belt, just, you know, um, what would I call it? Just, chugging cookies in your mouth. Very easy to swallow up, basically. It's a weird analogy. So we open here on equities open, and we have two sides, the sell side identified and the buy side. Now there's people getting on both sides, right? Maybe they got in somewhere in here, trailing the stop. Not trailing, but putting the stop there. Maybe they got in here, here, here. Who knows, right? There's all types of traders. But let's look at it as a whole, as a general thing. And who knows where they want to target. Okay, target lower. We have the buy side. So that's why that's buy side liquidity. They trail the stop here. They put the stop there or trail it there, depending where they got in. And now there's liquidity there. On the opposing side of the market, with the sell side, maybe they saw the market going up and they are buying it. Stop loss where? Logical level, swing points, right? Very rarely do people, less often anyway, do they put it at random levels. Sometimes at price points, but if they're using a chart, it's going to be at swing points because most of us aren't psychopaths. And that's generally where we would logically, with our, the way humans think, at swing points. So we got sell side there. Maybe they got in here, 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 here. Who knows, right? Maybe the thing's expanding and it took them all the way up here to believe in the move higher, and they got in. They couldn't. They were short bias, but they changed their mind because look at this, how bullish this thing is. Oh my god! Okay, this is going higher. We're getting a gap fill, guys. Look at this imbalance. Oh my gosh, ICT. I passed my funded account. That's the logic, right? But yeah, there's some other things at play. Anyway, takes out the sell side, and then we start moving lower for the real narrative. Okay, to attack the sell side down there, right? Why would we be going higher? We want to get somewhere fast, and we have an objective. That's all you need. Doesn't matter if you're using a ICT 2022 model, regular turtle soups, whatever. I have my own stuff that I use as well. It doesn't matter. But this in this video, talks about his Venom model, which is price attacking the buy side at this point of time after within this 90-minute window, or the sell side depending on the narrative. Okay, we expand up and we create somewhat equal highs, and we expand again and we take that out. Okay, he said it should be a body close above it, but I don't see it on this chart. Maybe I was mistaken, but the signatures are an imbalance up and an imbalance down, so you get somewhat of a balanced price range in the middle, and he calls those two things fangs, venom, right? Like a snake. It injected the poison and then it left. Okay. The entry he took was, I think, down here. Okay, at this fair value gap. All right, one could have taken it here, as a turtle soup, possibly, if they were, that keyed in or lucky. Or alternatively, at this rebalance of this gap over here, after taking out this, what's all this? No significant swing points, right? This is low resistance. Sloop. Thank you for that liquidity. Thank you for making making people believe that it's going to move higher, and then we start moving lower. Chop, chop, chop. Okay, and then we come down below the equities open, spin the order block, and we use that as resistance, and then we expand lower. Come down. We actually do come up higher again. Let's go to higher time frames just to have a look. 5 minute. Okay, yeah, because it's a big candle. No, fake. And then we go, let's go to the 20 minute. Just look inside of this range here, because we came down and we came up pretty okay. There's a little, yeah, so there's a gap here on the 20 minute between, strangely, okay, an actual gap between 9:40 and 10. Okay, so very interesting. Let's go to 10 minutes, probably there. It's not there on the 10 minute, but it's on the 20. 30 minute. We do see the actual gap here. 40 minute, 50 minute, 2 hours. Okay. Small, tiny gap here. It came all the way. You could say it came to this order block. Look at this. Yeah, came into that mini, mini order block. But in that small inefficiency, and then it left. Very nice. This is where I would have liked to get in myself. That would have been nice. I'd probably get in here. But the Venom model, yeah, that's basically what it is, according to ICT's video. Okay, but again, the important part is having narrative and and a bias. Okay, and if you're scared to take such things, you can wait for a lower time frame fair value gap to appear, or order block, or whatever it is that you trade, and possibly use that. Okay, so it's pretty simple. I mean, it's only 3 things you really need, right? So don't get too caught up. There's so many cool names that ICTA has come up with. The Venom model. What else was there? I can't think of it. The unicorn model. I don't know if he came up with that name himself. Some other names I can't think of at the moment, but it makes it sound really cool, and it is cool when you can do it. But that's just the entry model. So first, you need a bias. Where is the liquidity next, right? Where has it been, and where does it want to go next? Okay, and then you have a narrative. And I'm sure you know, if you've seen any of these kind of videos, you've seen these before, right? Bias, narrative, then you get your entry model. What's the narrative? How price is going to get there? Is it going to come fill in an inefficiency first on a lower time frame? Is it going to come take liquidity first on a lower time frame? You know, here some equal highs. It came here, and maybe that's your entry model. You don't have to take that entire move. Then maybe you target some lows. Target this low, or even this low. But you can see how it creates this. Yeah, you have to note that as well, huh? These are relative equal lows over here, sell side here, and sell side here. Okay, which further enforces your bias. Well, it should do anyway. So that's your narrative. How is it going to move? And then you have your entry, which is your model, right? Whatever it is, breaking, shift in market structure. Um, some people like to add retail indicators like RSI or stochastics or maybe even moving averages. Of course, not required, but if you use it along with this, then as long as you have your bias and narrative right, the entries aren't as important. But knowing where price is important, and of course, we get that by using ICT's core concepts of liquidity and efficiency. And when you add in the concept of time, it allows you to get in with a higher degree of probability, and getting stopped out a lot less. So yeah, I hope you found that quite useful, and good luck in your future trading.